You like some stocks like Comcast, which I should mention is the parent of this network, eBay, FedEx, U.S. Bancorp, Schlumberger. I mean, these aren't necessarily the growth stock names that have been catching the meme crowd by storm. Why is now the time to pivot into those types of names?
So we agree with Hughes' overall thinking that it's going to be a year of slower returns. We think the market regresses to the mean 9–10% returns. We think there are lots of places in the stock market right now that are pretty richly valued. There are companies at 40, 50, 100 times earnings. Those are the ones we're avoiding. The companies that we highlighted that you just mentioned, they're all very good businesses. They grow their earnings over time, yet they're all selling at about 14 or 15 times earnings. So we think they're going to be the place to be. We think the world slows down. It's going to come back to value. It's going to come back to higher dividend stocks. We're wary about the really high-flying growth stocks. And we think in that choppy environment, being with more secure, better businesses at lower valuations is going to make enormous sense. It's not going to be nearly as exciting, but it's going to be the way to be most profitable next year. Each of those companies that we highlighted, we think have 30 to 50% upside in the next 18 months.
Well, Hugh, I noticed that you like the dividends over at Abbott Labs and Pfizer. Those are also a couple names associated, of course, with this pandemic. Abbott with testing in particular, which has gotten a lot of attention over the past couple weeks with Omicron. Why are those not too volatile to bet on?
Well, I think they're a little bit volatile. But I go along with David. David's talking about value, number one. He also talked about dividends. You know, you've got attractive dividends for both of these names and dividends, which quite frankly make the dividend yield of these stocks compare well with the yield that you have on a long-term, a 10-year U.S. Treasury. So that's the kind of thing you want to buy. And I think the most important thing that I could say is I watch pretty carefully the relative performance not only of these stocks, which is positive, but the relative performance of the healthcare sector. And it's just turned positive. And I think it's turned positive largely because as investors start to pull in a little bit on risk, and it's turned positive largely because there's so much, as I mentioned at the start, uncertainty with regard to what's going to happen to the economy and importantly earnings in 2022. There's a lot of risk out there in 2022, not the least of which, of course, as I mentioned, Federal Reserve policy and fiscal policy, which are going to be important drivers.
Well, there's a lot that we don't know, David, but something that we're pretty sure we're going to get is midterms in 22, for example. Of the things that we know within some margin that we're going to get, what do you expect to affect the market? And David, how does that impact your strategy?
We think the two biggest drivers are going to continue to be COVID. Hopefully, it's getting more under control, hopefully with the antivirals that are approved today and with the vaccines, maybe with the booster or the next booster, we start to put COVID a little bit behind us. That's a concern, and that can change the market at any particular point in time. The Fed policy is going to be important. We think a lot of the stock market gains over the last 21 months, which have been robust, are driven by this enormous amount of liquidity. As the Fed takes some of that liquidity away, we think it's going to be a tougher environment. We think that from a political perspective, very interesting to focus on the elections, but we don't think that's going to be an overall driver of the stock market. Rather, it's going to be the economy, corporate earnings, and the Fed.